Well, thank you. Really nice to be thought of that way and to be invited. I want to say first off, though, that I don't manage the houses. These hands, if you shake my hand today, you'll see they're so soft that when I hold somebody's baby, I get chafed from the baby. So we have a great organization. I'll tell you a little bit about it as we go on. But how cool to be asked about just a little backstory. You know, it doesn't happen every day where somebody wants to know what. Nadine asked me, can we title this thing like Life as a Real Estate Entrepreneur or something like that? That's beautiful. So let me just give you a little bit of background and tell you, it's interesting when you think about some of the earliest genesis of your business memories of what made you think the way you did as a young person that then caused a lot of decisions that you made along the way. And then I like doing the Q&A, so you'll see hopefully as I go through a little bit of the background that I've got some cool experience that I can share with you. And that started where maybe the greatest thing ever for me as a business person was that when I was in grade school, my mom, who was, stay-at-home mom, taking me to practice, putting the Band-Aid on the wound, she was stay-at-home mom. And then right around like 5th or 6th grade, she went and got a real estate license and became a real estate agent. And a couple of years later, she was made the manager of her branch. This is up in the New York suburbs. So if you're not picking up my southern twang, you're not missing it. I've got the New York thing. But she, then a couple of years later, the partners of the firm that she worked in decided to break the company up, and she became the owner of her own real estate company. So I witnessed as a kid entrepreneurship in real estate right before my eyes, right? And it has a way of affecting you when you see it being done by mom. It's not like mom came out of, of an MBA program as a business person. She was just mom, and all of a sudden she was mom with a business, and I worked in it. I was answering phones. I was, stuffing envelope mailers. This is back in the 1980s, right? So when the cutting edge marketing was mailers. And taking pictures of houses when I got my license, taking pictures of the houses, taking the film to the pharmacy, waiting 2 days to get the film back, taking the pictures and sticking them in books. So I did a lot in and around the business. And the thing that, when I look back at my earliest memories of real estate, I realized being in that office so often that, because she would take me to work and put me to work, right? What was going on there was important, right? It was like, you could see it on the faces of the customers coming in. There was a lot of joy, there was a little bit of fear, there was a lot of nerves. And on the one hand, it struck me that mom had an important job, and on the other hand, mom's job got made fun of every time anybody had a chance to make fun of, when realtors were depicted on television, they were made fun of, right? So here's an industry that does something really important, but isn't taken very seriously at all, right? And that hit me because this is my mom, I wasn't appreciating that. But then as time goes on, you start to look at, I came to understand some point along the way that it wasn't that people lived there and raised their kids in the house. It was the financial import of what was going on there. It was the nerves and the fear that was associated with this thing that I saw in the conference room. The joy was easy to see, but when you saw the faces of people that were signing papers and looking like they were, signing their lives away, it was the financial scope of what was going on there. And here was an industry that was a financial services industry, but yet it kind of looked like Mary Kay Cosmetics at the same time, right? It was very serious and yet not so serious at all. That was the takeaway as a kid. Like, I get why the public makes fun of them because of the way they carry themselves, but yet what they do is so important, they don't get enough appreciation. So that was the first formative thing. And the second thing was, I just turned 50, and so I was around in my early 20s when something called the information superhighway came around, right? That's what we used to call the internet back when it was brand new. When I was there answering the phones, the phone calls were always, can you tell me the price of the house on Maple Avenue? And at one point, I would write the ads for the classifieds, right? I remember asking this question, why don't we put the price in the ads so they don't have to call? And of course the answer was, that's why we don't put the price in the ads, because then they have to call, right? And so years later, when the internet, when you start reading about this thing that's happening, that's providing unprecedented access to the public to all kinds of information, it hit me like a ton of bricks that this industry may be over, all right? Because the industry likes to think of itself as a people business, but before it's a people business, it's an information business, right? And back then, Like we were an industry that we had those terminals, right? Back before doctors didn't have them, lawyers didn't have them, but the real estate office had those computer terminals, those MLS terminals way back in the 1980s. So I was familiar with technology from that front, and the idea that this terminal could actually be out there for people to use was going to change everything, right? And maybe the industry was going to get undone as a result, but that was the other formative thing, is that technology is going to collide with this industry in a very big way. And this is all back in my early 20s. And so when I was a young guy in my 20s, I was a loan officer in the mortgage business, and I was doing great. I was six figures at 22, and it was just knocking them dead. But then when this whole trend came about, I decided to throw everything into real estate tech, because I just thought this is the reason why the industry is not taken seriously might be that we won't tell them what they want to know when they call, right? Can you see the connection there? Like literally, I was saying, they only want to know what the price is. Why don't you put it in the ads? And the answer is, we put it in the ads and they won't call. We have to make them call. So we're making ourselves difficult. We're actually becoming an obstacle intentionally. Maybe that's why they make fun of us. There was the connection between the two. So anyway, real estate tech, I ended up getting hired at that time by the company that owns Century 21 Real Estate and Coldwell Banker Real Estate. They're now called Realogy. They're the big gorilla in the real estate brokerage business. And they sent me on tour. It was called Tech Tour 95, right? I traveled the country. Yeah. Tech Tour 95 was a national tour for real estate agents, audiences of anywhere from 25 to 300 people, half-day seminars on technology. And the whole purpose was to get them not to be afraid of the internet, right? That was the whole purpose. And literally, I still have scars from getting kicked in the shins by blue-haired ladies who were like, because I would actually say, like, if you don't adopt this stuff, maybe you're going to get replaced, and they would come at me. But I'm talking about showing them the first digital cameras. Funny stories about that. Like, the camera was the crown jewel of the 3-hour seminar. So I pulled this camera out. Looks like a camera, right? People in the front row, snap a picture, plug it in, and that was when the picture would paint. Remember that back in the day? Those of you who are old enough? Picture would paint. And I remember I did this in 75 cities, right? And sometimes you look around the audience and it'd just be fun, because you'd be looking around and watching the faces as they see the people in the front row, as the faces begin to, they don't know what's happening right now. They just know I took a picture and I wasn't going to the pharmacy to get it developed, right? It was actually painting. And sometimes when the picture came across the top, you'd see some people who were like El Diablo had appeared, like I was stealing souls with this thing. And then I would say, why don't you take a picture of me and my friend over here? And people would hold this camera like I handed them like a spider. I don't know how it works, right? And the answer is, how does film work? What are you talking about? Point it, click it, right? So anyway, it was a fun experience because we had this chance to try to break the ice in the industry. So fast forward, I ended up staying in that corporate gig for a while, took over Mom's company in the late 90s. My brother and I, we took it from 7 million in revenue to 50 in about 7-8 years. And it was all based on this idea that we were a suit and tie real estate company. We wanted to be taken seriously. We joined the Prudential Network, financial services company. So this idea that real estate is a financial product, the industry is not treating it that way. Real estate is a technology-enabled thing. That was the basis of our entire brokerage experience and concept, and we killed it, right? We dominated. Then the housing crisis came along, and my life was like coming full circle at that time. I thought, now it's going to happen. Like the big takeaway for me from the housing crisis 10, 12 years ago was that nobody understands the housing market. Government did the wrong thing. Lenders did the wrong thing. Consumers did the wrong thing. Realtors were along for the ride. They didn't stop anything. Right? There was literally nobody who had any understanding of how this asset class actually operates. It makes sense. It's kind of an unserious industry and a very serious product, right? And so I left the family business and I started a company called Own America. And the concept was, the housing crisis is going to give way to a massive investment boom, right? So I didn't buy in. So I wrote a book called Crash Boom in 2010. Gives you an idea of what during the crash, I was trying to remind everybody what everybody I think already knew deep down inside, but you could be fooled by reading the headlines, right? Housing meltdown, housing freefall. So I threw myself into it, started this company, and it was all about enabling the investment boom. I believed that investors were going to save the housing market. They did. All right, they showed faith in the housing market when nobody else was showing faith in the housing market. And we set out to build technology and a national brokerage operation to just basically help investors deploy their capital and invest, right? So 9 years later, I sold my company to Renters Warehouse. And the reason I did that is that I managed to be a national company, but only because of the web, right? We were national, but we were not on the ground anywhere, right? And you can treat residential real estate as a financial product all you want, which is what we did, but it's a physical asset too. And if you only do half of that, it's too vulnerable, it's too risky. But along the way, we landed all these big Wall Street clients. You guys and gals are familiar that Wall Street converged on real estate 6, 8, 10 years ago, right? Those were our clients. And so we built technology for them. We had our national army of real estate agents that we trained, and we helped them identify what markets and what sub-markets were going to pop more than others, what kind of assets to buy, help them acquire and accumulate these 10,000, 20,000 unit portfolios of houses. But along the way, literally every one of the top 18 investors on the planet in single family real estate were clients of ours. And every one of them showed us their criteria. Every one of them, to one degree or another, wanted us to tell them, where do you think we should buy? They didn't always listen to us, but they always asked, right? And then we always saw what they did with that information. It was very transparent. So I got a chance over all these years to witness literally tens of thousands of real estate investment decisions being made by people who were, some of them were highly educated Wall Street folks, Ivy Leaguers, and a lot of them were rough and tumble, gritty, entrepreneurial real estate investors, which frankly I like more. Okay, that's why I like being here, because that's what I think you guys and gals are, is that we're of the two groups, my impression is you could teach them more than they could teach you, okay, about real estate investing, meaning the people who are entrepreneurial in the trenches are the ones that actually know more than the folks who are in the ivory tower doing it. However, I've had a chance to see a lot and do a lot on all those tens of thousands of investment decisions, and I learned along the way that what I wrote about in the book was right? Being able to read the tea leaves on population, standing way back and not getting too seduced by great deals, focusing first on where to invest and then worrying about what secondarily. Right, there are people here who I'm sure find unbelievably great deals. I was never good at that, again with the soft hands, right? I'm not going to repair anything. I was good at finding, my thesis is find the pockets that are going to have more demand lifters than other places. All right, if you could find one demand lifter, another demand lifter, if you can find the nuances that are population oriented, where are people going? Why are they going there? Is that going to continue? Right? You can find the things that are going to give a market extra lift off. And then my goal is to buy the nicest properties that I can in those places. So the effort and the energy is spent on where, not what. And I phone in the what, okay? And so I know a lot of you folks probably do the what a lot better than I do, but I do the where really well, all right? So what I want to do is share a couple of things with you, and then just open it up to whatever questions you might have that I might be able to give you one man's opinion on. Renters Warehouse is the biggest single-family property manager in the country. So they manage 25,000 houses. The reason why we got together is that about a year ago, I realized that I was vulnerable. I was a national real estate platform online, but I wasn't selling stocks. I was selling investment real estate, and it's a physical asset, and the game wasn't going to be won by somebody who was at 30,000 feet. And it wasn't going to be won by somebody who was only on the ground but didn't have the ability. This is a company that has 41 branch offices, 350 employees, never sold a piece of property yet. Okay, so we're literally taking a real estate investment platform, landing it on top of a property management company, and building America's first real estate brand for investors, right? So one of the things that I have been mystified by for going on 26, 30 years now is why you aren't the focus of the industry that sells homes, right? Some of you, there are probably realtors in here, so I take that back. At the real estate agent level, there are people who dedicate themselves to investors. At the real estate company level, not so much. At the national franchise level, at the strategic level, at the technology level, like go search Zillow for investment properties. Not going to find it. Okay, go search any real estate website for, I want to buy houses that are occupied. What's the rental income? What's the NOI? What's the yield? Like, they think yield is a triangular sign that means that person goes next at the turnabout, right? So there's a big deficiency in the industry. And the dream of Own America from the beginning was to be America's real estate. Like the intersection of Charles Schwab and RE/MAX. Think of it that way, right? A wealth management firm that uses residential real estate as the vehicle. We don't sell stocks and mutual funds. We sell and manage rental property. And so we're looking to activate as many people as possible. I believe that 10 years from now, we'll be a household name. Like today, if you said to people out there, name an investment firm, they'd say, maybe Charles Schwab, maybe E-Trade, maybe Merrill Lynch. If you then said name a real estate company, they'd say Coldwell Banker, Keller Williams, RE/MAX. If you said name a real estate investment company, you'd hear crickets, right? Because there isn't one. We're going to be that. And we think that what that means is that more and more and more everyday people who are responsible adults trying to save for their financial future, trying to set their kids up and their grandkids up, trying to build a financial legacy, that they're going to have a handful of rental properties. That's all. Instead of busting their butts to work or run a business, make money, and then give it to a stockbroker, they're going to give some of that over to owning property and building that legacy. And the beauty of it is now that we're revealing the ROI profile of single-family homes, it outperforms like everything else, with the possible exception of multifamily buildings, okay? But real estate outperforms Wall Street, okay? The difference is nobody illuminates what those numbers actually look like. So like we all know people, and maybe you are people that you make money, and you know people who have made money that have built wealth, but if you ask them what the ROI was, it's like that most answer like it was good. ROI was good, right? But there's no number. Wall Street gives you a number. We don't have a number. So we're out to do that. So I want to just run through what I think is the most important chart in the world. Not in real estate, just like in the world, the most important chart. And then I want to give you a couple of examples of local markets. This is my lifetime in residential real estate. That's 1968 down there. God, there's a lot of years on this chart. This is, why do I keep saying my lifetime? I could probably easily get away with, well, not with the hair. Anyway, what's interesting about this, do I have a pointer? I think I have a pointer. Somewhere around here is a pointer. Here was the real estate crash of 1981. Here's the real estate crash. This is home values in America, all right? Now, there was a crash, but the weird thing about this wasn't this, was it? Now that you see it in context, the weird thing about this was this. That's what didn't make sense, right? So you've got wartime, peacetime, Democrats, Republicans, high rates, low rates, good economy, bad economy on this chart. And by the way, if you go back to the 1940s, it's the same thing. All right, it's just been going gradually up. A little bit better than inflation, okay? It's tied to population growth. It's not complicated. People want to live indoors. They want to live in America. That's it, right? So I always find it really interesting when people, like my mom, argue with me about the housing collapse of 1981, because she was in the business back then. You know what collapsed in 1981? The real estate sales business collapsed in 1981. Right? Nobody was buying houses when mortgage rates were 18%, but the numbers don't lie. It wasn't a collapse if you own property. It was a flattening out if you own property. If you sold property, it sucked. If you own property, it was just a little bit of downtime, right? Same thing here. The real estate crash of 92, not really, right? And this, isn't it uncanny how it went up and then it came back and fought its way back? And maybe it's a little high right now, but notice this right here. You see how it's kind of like leveling off now? Maybe it was getting a little bit too hot, so the market's easing up. When I see this, what it tells me is it's resilient. Okay, this represents 100 and something million transactions negotiated between usually one seller trying to get the best price, one buyer trying to get the best price, and it gives you this incredibly resilient, gradual upward trajectory. So when you hear people say, and I hear it all the time, oh, well, what goes up must come down in real estate. Wrong. It happened once. All right, and it happened for reasons that were explainable. This was self-inflicted, right? We all know what happened, right? I mean, the industry of lending and government wanted to promote home ownership. They created funny money, right? So you could afford $200,000, but you had a blank check for $300,000. So you went and drove the numbers up, right? I want that house. I really want that house. It's a bidding war. Bank says I can afford $300,000, and out came the check for $300,000. It drove prices artificially up. And I think of this. Remember the movie The Revenant? Leo DiCaprio and a grizzly bear. Anybody see that? All right. So The Revenant was a great movie, but there was a scene where he came across this grizzly bear and her cubs, and the grizzly bear just kicked his ass for like 8 minutes, right? Just mauled him, beat him up, bit on his head, scratched him, sat on him and caught his breath for a while. That was like the best scene in the movie, right? Just all of a sudden the bear just like, oh, this is exhausting beating up on Leo DiCaprio. And then gets up and chews on his head some more. That's what happened to all of us. The housing market is a sleeping, lumbering bear that if you leave it alone, everything's fine. If you poke it with a stick, it mauled everybody. But then what happened is it went back to sleep again and everything has gone back. It's uncanny if you follow this line. Damn it. If you follow this line, look where it bounced. It's right there, right? So that gives me a lot of faith that the recommendations I'm making are sound, because even after this stress test, the market came back strong. So then if you go market by market and look at the same thing, this is data, by the way, that you can find on renterswarehouse.com. When we were working with Wall Street, we got real mastery over housing data, population data, job and crime, and all these things that feed into the demand drivers of housing. And we mastered that stuff for them and with them. And then we woke up one day and said, everybody deserves this. Let's just take all the technology that we know how to build and all the data that we know how to get our hands on and create a way for everybody in investment to be able to get their hands on it for free. So this is all free, all right? We give away everything we know and everything we know how to do for free in the hopes that you maybe will buy some property from us and maybe let us manage it for you. That's all. And if you don't do either one of those things, we're okay, because we want to see I love this industry. I love the fact that if you want to learn about real estate investing, the best source has always been each other, right? That's why you come to these things. Everybody's willing to share. Like, for some reason, this industry is not secretive. Some folks race out and want to sell you a system, but a lot of folks just want to give it away because somebody gave them free advice early on, right? And it kind of has this whole pay it forward vibe in the industry. So we buy into that. So this is free. You can go in, open a free account, load your properties in there, load properties in that you want, they're all private, load them in, properties you're thinking about buying, and see a ton of analysis. But this is the money chart right here. The long-term price appreciation. This is 20 years. So this is not my whole life. This is since my hair started going gray, right? But you can't see the numbers down here so well, but the national average of appreciation over the last 20 years is 3.44% per year, okay? Wartime, peacetime, cats and dogs, Democrats, Republicans, good economy, bad economy, 3.44%. This is Charlotte, state of North Carolina, 2.3, Charlotte, 2.8. But what I love about this is you can see the stress test. Here's that same blue line where it took off, came back down, fought its way back, and picked up the trend line where it left off. The black line is North Carolina. So what do you learn when you see this? You get a chance to contrast three geographies: USA, North Carolina, Mecklenburg County. And you can draw conclusions. One conclusion is North Carolina was less volatile than Mech, was less volatile than the country. So what does it mean when a market is less volatile than the rest of the real estate economy? Stable, right? I mean,
higher return for the risk you put out.
Right, right. It's just you're investing in something that during the stress, remember the stress test, right? If you think you know, at a certain point in life, maybe they put you on a treadmill, they make you run really fast to see how your heart's going to handle the stress test. This was a real estate stress test right here. So when you see how markets work during that period of time, and so, but again, here's the state, it came down, it came up. And what I learned to do is if you start in the beginning of any one of these curves and you split the peak and trough and carry it forward, you're seeing where the market kind of wants to be. And so the green line's a little high right now. So my prediction, I think this is a lot higher than 2.8%. That's a 20-year average. This market has been banging. I think it's going to level off and catch up with this line. There's nothing that tells me that this is going to decline in value, because the reason, my opinion, why this has been so resilient is that when the economy sucked, people left New York to come where? Places like North Carolina. So even though the economy wasn't good, it was actually driving more population, more real estate demand into our arms, right? But I'm going to bounce around now and show you more places. Here is Houston, Texas. Again, blue line still stands. Houston's exciting because all along, so no housing boom, you know, so no party, no hangover, right? Little tiny hangover, but that's kind of more of an anomaly. Houston didn't participate in the housing boom or the housing bust, but then it went crazy. But along these lines, I could show you headlines back here that Houston's over because oil prices are low. Done. The headlines said that there's only one industry in Houston, that's gas and oil. So when gas and oil got cheap, which is good for all of us. It was bad for Houston. Houston is done. Houston Chronicle, right? That was right around here, okay? Then we had a hurricane right around here. Houston is finished, right? It's over. What's my point? I hate media. I hate the way they report the housing market. They don't know anything, and they're stupid, and don't listen to them, okay? I just get it off my chest, right? But I think Houston's a little bit high, but look at it, it's uncanny, right? Let's bounce around some more. Here's Atlanta, Georgia. Now Atlanta, different kind of story. Atlanta did party pretty hard, had a really nasty hangover coming down, but it's caught back up again. But if you start here, split the peak and trough, carry it forward, it kind of caught up to where it wanted to be. It may be a little bit high again, but I think it's going to level off. What made Atlanta different than Charlotte and other places was the new construction boom was off the chain back then. They built so many new developments down there that when the music stopped, there were all these half-built subdivisions that just broke in half. All right, so they had this really massive glut of supply, and the glut of supply that we didn't have here, they had there, and so home prices plummeted as developers just gave the bank the keys, and the banks gave the keys over. So a lot of investors made a lot of money, but what do they bet on? They bet on population growth in Atlanta, and they won. Tampa, Florida. All of Florida is kind of like this, okay? So big party, big hangover. Again, start at the beginning, split peak and trough, carry it forward, it's right there. So I've heard people talk about how the cities in Florida are in big trouble. You know why? Because the only thing they know is this part. They're analyzing just this part. Well, this looks a lot like that part. So this was a housing bubble, this must be a housing bubble, except they didn't realize that they're still catching up all these years later, right? Again, context. You have to stand on the moon, look at the housing market to understand what's going on. If you look at the short-term stuff, you could get fooled. I know people who aren't going to buy in Tampa because they think it's a bubble because of that. I think they're wrong. I will be proven right. All right, here's Phoenix, same kind of thing. There are people who think Phoenix is taking off too much. Phoenix is going to be in a bubble also. You hear this all the time. You hear CNBC, housing bubble on the horizon, recession in 2020, like it's wishful thinking or something. Why would they be wishing for a recession? What's happening in 2020 again? Look at that unmistakable trend line right across the peak and trough right here. All right, and I see this leveling off as a really, really healthy sign for Phoenix. Is that making sense? So now I'm zigzagging across the country here, and the same thing is holding true no matter where I go. That if you split the peak and trough and carry it forward, these markets are doing fine. Kansas City, no party, no hangover, all right? So with Kansas City, the story is just resilience, boring. You get a higher yield here because the prices are low. They haven't really appreciated, but it's popping a little bit right now. Not sure if that's going to continue. But again, it shows you that there's just one way or the other, these stories, these charts tell a story. Baltimore, interesting market there. Everybody's afraid of Baltimore, right? They think Baltimore and Detroit are two cities that have really bad headlines, right? You ask people, tell me about Baltimore, and they are telling you about, cars on fire, right? That's what they think of. Baltimore is DC. This is one of the best charts you're going to see in the entire country. Big party, not much of a hangover, plenty of upside. The trend line is spot on because Baltimore is not Baltimore. Baltimore is essentially a suburb of Washington, D.C. All right, so all the cybersecurity, right? Big industry for Baltimore right there. Prices are still relatively low. Yields are relatively high. Wall Street's afraid of it. They won't go anywhere near it. All right, but again, people would tell you, if you ask people about Baltimore, they would tell you, oh, it must look like this, and then crash. Well, no, it's actually held its own. This is identical to the DC chart, except DC chart is a little higher up across all of the years, right? Started off more expensive, ended up more expensive, same exact shape. Oh, Detroit. Yeah, Detroit, interesting story because it's the only market in the country, major metro, that's down, that's negative 0.6% appreciation. We all know the story in Detroit, but it became a buy for us right around here because the problem in Detroit was erosion of the jobs, right? Auto industry vamoose out the door, corruption in the city, bankruptcy, but the bankruptcy was the solution. So as soon as it came through bankruptcy, we said, okay, something's going on here. They put a professional emergency manager at the state level in charge of Detroit. They negotiated all the pension obligations they couldn't pay, came out the other end of bankruptcy with a clean slate, And now the auto industry is being muscled, bribed, cajoled to come back, right? And they're making long-term commitments to building new factories, reactivating factories. So this might be the best buy in America right here. Because the average price is you can buy a house, you can trade in your Escalade and buy 2 houses in Detroit right now, right? And the yields are in the double digits. Denver is a great story because Denver again took off and they got weed right here. Now, you don't have to love the, politically I don't care, right? This is an investment thesis. The cannabis industry is going to be a monster, right? And now every state government in the country, some said no way, no cannabis. Some said maybe cannabis. Denver said embrace cannabis, right? And all this infrastructure is being laid down now where the cannabis industry is setting up shop in Colorado. And Denver, while you might look at this and say, well, I might have missed the ride, I don't think you did. I think it's going to keep rolling. This happened right here because of the lifestyle in Colorado. Everybody who goes there wants to stay. Healthy lifestyle, fresh air, outdoors, all these core fundamental things. And it's a big city of industry. But now I think it's going to keep going because they landed a whale. Again, unemotional about the politics of it, right? And the sociological impact of cannabis. Doesn't matter. Just like I don't care, Western Pennsylvania is a big shale fracking. Don't have to love shale fracking. It's exploding because the energy industry is setting up shop in Western PA because Western New York won't allow them to come in there. All right, so I find this stuff, like I don't have any hobbies, guys, okay? So to me, excuse me, see I'm knocking people over. I don't have any hobbies. This is what I love to do, is try to figure out these macro changes. And then once I get into Denver, if this is too hot, well, then what's the next thing to pop that is like Denver, but not Denver? Maybe Denver 10 or 12 years ago. And the answer to that is Colorado Springs. Look at the green lines. They're like almost identical. They come up, they come down, they bounce around. Almost identical. Except that one of them took off, one of them hasn't yet. 45-minute drive north of Denver. Everything else is the same. Like this is a winner right here. We get asked a lot, by the way, and I'll just segue real quick. We get asked a lot, okay, I missed Denver. What's the next Denver? Colorado Springs. We missed Nashville. Nashville took off. All right, what's the next Nashville? Chattanooga. All right, same chart, different ending. Chattanooga is the new Nashville. Same fundamentals, and I think it's catching on now. So we're recommending Chattanooga. And this, as I mentioned before, like Pittsburgh is amazing. Straight line. Hasn't even really started to show up yet what's happening with the shale fracking.
Pittsburgh is building 3 brand new refineries.
They're building 3 brand new refineries.
Right now, you're talking to those guys, you're saying that's going to become the next Houston because the oil pipeline comes across right through the Ohio-Pittsburgh Valley.
Right.
So I was just up there last week.
Were you? Yeah, it's all happening. And this is not temporary. This is not like, oh, we changed our mind. They're building refineries. That's a 200-year commitment right there, right? And so, and what's funny about Pittsburgh, I'll just tell you, we're changing the data that feeds these charts, gives you annual price points, so you can see this sort of trending. We're changing on Thursday of next week, new data comes in that gives a monthly. And what you would see was warm climates, smooth, cold climates, heartbeat. All right, it goes the same, you'll see the same thing, but you'll see this. You know what this is? Winter, summer, winter, summer, winter, summer, or winter, summer, winter, summer, winter, summer. I asked an audience in Denver, in Pittsburgh, like, what is that? It's like this unmistakable cadence of, you know, December, June, December, June. And they said, it's cold as a witch's tit in Pittsburgh. Okay. So but the point, and somebody else said football. But the point is that stuff matters. This data tells you things. Now, if I'm investing in Pittsburgh, I'm waiting until October, November, December. Because the demand cools down, no pun intended, and you can get a better deal, not because cheaper houses are selling, it's just people are getting better deals, not because they're buying houses that are in distress. All right, Dallas, like a bat out of hell right here. What's the new Dallas? Oklahoma City. All right, same chart, different ending. Same industry, same fundamentals, just hasn't happened there yet. All right, that's it. Who's got questions? Anybody? You got an investment thesis you want to bounce off of me? You've got a market you want to ask? How do we? Those are free on renterswarehouse.com.
Where?
Renterswarehouse.com?
On Renters.
Oh, okay. The investor marketplace. Okay, so you register, open a free account. That website, by the way, it's not as easy to find as it will be shortly. The reason why it's a little harder to find is we took Renters Warehouse website and ownamerica.com and just like mashed them together to build them into one website. And there was a lot of things that were competing for the real estate on the homepage. My stuff's going to wind up being on the homepage very shortly because it's the coolest stuff.
Tuesday or something, podcast, right?
Yeah, I do podcasts. Yep.
Isn't it every Tuesday or something?
No, it's a little bit random.
Or something?
We do a Friday Facebook Live event that I can't do this Friday because I'm going to see my mom in Florida. But every Friday, 3 p.m. Eastern, we do a Facebook Live where I just do Q&A. I love answering questions. So there was a couple of hands that went up, so I'm happy to. Yes, sir.
Yeah, one of the things that's happened here in the Concord area, I guess for 15, 18 years, they were building pretty good, nice, single-family home subdivisions in the 130s to 200s. And then about 2 years ago, they just went insane building apartments. Thousands and thousands of apartments.
Yep.
No more single-family homes. What is causing that in the market? It costs just as much to rent an apartment as to buy a house. Why are they building apartments instead of homes?
I think developers had approvals, and I live in Mooresville, same thing. Developers get approvals, they get the zoning allows it, or they get the zoning to allow it. Like, I don't know anything about the politics here, but whenever I see that much high density, I think people are chummy, right? And so I don't think it was, I think it's, I can make more money building high density apartments here, traffic be damned. They do it, and the economy is good, so they crank them up as fast as they can while the economy is strong, because they expect it to go the other direction. Now, what's interesting is, does that cause you then to say, maybe I shouldn't buy single-family homes around here because I have a lot of competition? But you said the key thing, the rental. I mean, at the end of the day, if you've got kids, you want a dog. If you want a dog, you want a house. And so your product competes really well against apartments, but there is a bit of a glut of supply out there of rentals in a lot of places north of the city.
Of apartments or single-family homes?
Apartments. Yeah. Yes, sir.
You touched on the economy a little bit. What do you think? Talking to a lot of my friends and associates in the business, what do you think about the market over the next year or two with the Fed, the rates, and because I have a lot of clients and friends who think there's going to be a hard correction, if not a recession, in the next 2 years. What are your thoughts on that?
I don't see signs of it. Okay, so recessions. I understand the idea that when the economy goes too well for too long, that it's going to correct. Okay, so that's just like a kind of a fact of life on the overall economy. Housing is not like that. I showed you the chart. Housing doesn't participate in most of those things. All right, it only drove the recession one time, and that was the one we showed a couple of minutes ago. So I look at fundamentals of the economy. Consumer confidence, fantastic. Employment, fantastic. Okay. Take-home pay. The reports are coming out today with people who didn't really want the tax cut to be a good thing, had to admit that there's been a lot of tax cuts and a lot of people have more take-home pay. So if I look at it, if I ignore for a second the fact that what goes up must come down and say what's actually happening, I don't see it. I just don't see it. And I think, like I can tell you, if you do a search for the words Zillow Recession 2020, you'll see 250 pages of results on Google for Zillow Recession 2020. I had this slide up here. I took it out. I should have left it there. Because what I want to tell you, this is that perception is created by things like that, right? Now, if you read Zillow's study, actually forget that. You read the headline, Zillow experts predict recession in 2020. Subheading, not even in the body of the article. Subheading, nearly half of the experts agreed there would be a recession in 2020. Now, when nearly half agreed there's going to be a recession, what does that also mean? No. Most of them didn't think so. Right. So what you know is you got somebody who is decided on the outcome of the survey before they took it, and then gamed the headline, and then came clean in the subhead so nobody could accuse them. There is a wishful thinking thing going on there. It could be that Zillow wanted to create a lot of listings because Zillow is now doing instant offers. And it could be a political thing. There's a lot of that going on, you know? And again, I don't care which way it's going, but I don't like anybody who wishes for the market to go badly, no matter who's in power. Anybody who wishes for things to go bad so they can get the reins back upset me. It upset me both sides. So I think that's what's happening now a little bit. Yes, sir.
Could you give a couple examples of the demand lifters in the area, in Charlotte, Concord area?
Sure, yeah, great. So So I've been studying Charlotte. I have a buying plan this year. I'm actually waiting till the fourth quarter of the year to do the buying, so I'm doing the research. But I'm done doing the research. I landed on the Gastonia trajectory, and I'll tell you why. I love all of it, okay? So multiple demand lifters. Number one, North Carolina. Number two, Charlotte, right? So the macro numbers on these southern cities are unmistakable. Economy is good, people move down. Economy goes bad, people move down faster. Okay, quality of life, cost of living. Now you get into Charlotte, you say, now what pockets are working? Number one, they built like a 3 million square foot facility, Amazon distribution facility down by the airport. We've got one here, got a big one here, but they've got a bigger one down by the airport. That means two things. What's that?
And a bigger one coming.
Yeah. So the one by the airport is 2,500 jobs.
Biggest Amazon building built yet.
Yeah, it's a beast. It's a monster. You drive by, you know what it looks like? It looks like a mall. And it kind of is a mall if you think about it. You just don't get to go inside.
It takes you over a minute on the freeway to drive by.
Yeah, yeah. So it's a mall that we don't go inside. It's a mall that we order and they bring it to us. You've probably started seeing the little Amazon vans going around. So we all get, like if my charger gets lost, I say new charger, ding dong, and my charger comes in, right? That's what's gonna happen. But that's 2,500 jobs, pay rates $40,000 to $55,000, renters, all right? Western direction from the city. Now you hop out about 12 miles. You got Belmont, North Carolina. Belmont just got approval for a train station, light rail into Uptown. So you're 12, 15 minutes into Uptown, and there's no traffic on those train tracks. Okay, so that is the kind of thing that I look for. When you see a train tracks going, now you guys can't all go buy in Belmont, because I'm buying in Belmont. So if you see me in a bidding war, you got to back off. That's not fair. No, but seriously, right? When you see that, now I was watching that. I didn't spring on it fast enough. Then I was watching it. It was being proposed. It was being voted on. So what did I do? I set up a Google alert. Belmont train station approved, and Belmont train station declined. One morning I got up, Belmont train station approved, is sitting in my inbox. My first reaction was, I was right. I'm an idiot. I'm a chicken. I didn't go and jump in before it got approved, right? So I missed pre-train station approval, but it hasn't opened yet. The day it opens and you can actually essentially walk to Uptown from Belmont, prices are going to pop walkable to that train station. Now you go one more hop, another 10 miles further west, you've got Gastonia. And if you look at the whole Charlotte metro area, you've got, here's Charlotte Uptown. You've got Huntersville, more expensive than Gastonia. You've got Concord, only a little bit more expensive than Gastonia. You've got Ballantyne, a lot more expensive than Gastonia. So it's the cheapest outlying small market outside of Charlotte. If you drive down the street in Gastonia downtown, what you see is one store after another with 4 rent signs, which are different than for sale signs. These are already renovated. They were for sale signs a year or two ago, probably. Now they're renovated for rent signs. So somebody thinks that downtown Gastonia is going to catch on. So they've bought these properties, they've renovated them, now they're renting them out. The smart money, I think, is that they're going to rent those things out. I'm not buying retail because I'm not going to buy retail within 20 miles of an Amazon mall, right? I think that's scary. Although I think they'll be fine because there's going to be breweries and coffee shops and flower shops and things like that. But I'm going to go a few miles out around Gastonia and pick up single family homes. So I don't you can't lose, I don't think, in Mooresville or in Concord or in Gastonia. You're getting all the lifters of the whole Charlotte metro. But there is a little bit different because of those extra sort of sparks of demand. That make sense?
Yeah, very good.
Okay. Yes.
What are your thoughts on Salisbury?
What do I think of Salisbury? I like it for the same reason. Again, it's another step out, right? A little further out. See, I'm half Italian, you know? It's just one of these things. When you look at these cities and you start drawing these rings around them, right? These cities that don't have any limits on how far they can sprawl, those are the places like Statesville is another example of a city that's kind of on its own, but because Charlotte is not really a circle, it's more of a pear because of the lake. The lake has a different kind of gravitational pull, pulling people up here. So the hop of Charlotte to Concord and Gastonia, and then further out, the next stop further out, it's going to take longer to get there. But I like it. I like all those things. I like, the whole 1 hour circle around Uptown Charlotte, I think is a good bet. You're going to wait longer for it,
Right.
is all in terms of the appreciation.
See, I thought, I'm a New Yorker, so I see the world as circulating around New York City.
Right.
As we all do. But like I watched Manhattan, Brooklyn, Queens. Well, I watched that in the last 10 years of doing business up there. So I came down here because I see the same thing. I see the same exact phone with Charlotte, Salisbury.
That's what I'm talking about. I grew up in New York also, so it's the same thing. You see how far it'll go? Because what winds up happening is, here's what happened in New York. The business and the jobs were in the city, so the suburbs were here. Then the businesses moved to the suburbs, and the rings extended out. People are willing to commute 45 minutes in New York. So you picked up, Putnam County and part of Dutchess County, all the way around to outer Suffolk County, all the way around to, Monmouth County in New Jersey, Rockland and Orange County in the northwest trajectory. So it has that way. When you see the jobs begin to move out, then you know that there are people that do that two-step actually happens. Yeah, so I'm on the same page.
Okay.
Yes, sir.
As far as the supply and demand, and as far as the apartments and the housing, do you think the millennials are playing have a huge impact on that because they're not willing to settle down, I guess, or buy something permanent? They rather just rent.
Yeah, well, here's the thing about millennials. They're people, like everybody else. They're going to live longer, they're taking longer to settle down. That's what I've always thought about millennials, is when I was in my 20s, my housing decisions were based upon how close I could walk home from the bars. And then I had kids, and my housing decisions became, where are the best schools? Same person 3 years later, all right? So millennials maybe wait until they're 32, 33 years old to be thinking that way, but it's just DNA, right? I mean, you eventually fall in love, have a family, settle down, and everything else, and then different things become important. So I never bought into the idea they don't want to own homes. I think you're just asking people too early about buying homes. But one interesting story is that these are just anecdotal, but millennials, there were two reasons why they would give you, when the stories were abound about how they don't want to become homeowners. Two reasons. One was, I don't believe in the housing market because they lived through the housing crisis. The other was, I want to live the mobile lifestyle. I don't want to be tied down. I think that's the bigger reason. I think that the faith in the housing market thing is actually fading, and what is maybe still there is not wanting to be tied down, but millennials like investing. That's what, again, anecdotal stuff, but I pick up on that. You go to some meetups and it's all, I went to one down in Uptown Charlotte and it was all millennials, and a lot of them were renting where they live, but they want to buy investment property. So they buy into the idea that owning, I call my company Own America because that's what I think the experience is. The best product in human history is this country, and you can actually own it. It's insane that you can actually own this. It's the best thing that you could possibly ever own, and you can. So it's wired in. People understand that. And so that's why we're trying to make it easy, because it is really hard, except if it were easy, it's like transparent data, good service, people that can actually sit down with you, explain to you how it works, easy financing, easy insurance, and then easy to own because of property management. If all those puzzle pieces were in place, I think you're going to see massive volumes of people that are coming to do it. And when they start to understand the way that the data actually shows the performance works out, I think millennials are going to be right on board just maybe 6 or 8 years after everybody else.
Yeah. I was still in high
Yes.
school when that crash happened.
You were still in high school when the crash happened? Did it shake your faith in the housing market? I grew up believing the housing market always goes up because it always had in my lifetime. What was your belief system?
I had probably bad teaching from parents who didn't really understand investing and all that. So probably when I was in high school, I just believed whatever my mother told me.
Okay.
So investing was always bad. And real estate was bad because it's not safe, or it's not
Right.
It's not feasible to do.
That people's experience was different. That's the point, right? So when you grow up and everything is a certain way, and when you grow up right in the middle of that, and people are going through foreclosure, it's on the news every single night, and your parents are worried about it, that's going to affect your point of view. But so you changed your mind, though. Mm-hmm. What changed your mind?
I would say just kind of having them. I kind of, I guess, just want to be different than I come from a family of people that kind of broke lifestyle.
Okay.
Doing something different. If they're saying this is bad, they probably should do it because.
Interesting. Okay. So you're saying, okay, the results weren't as good as you want out of life, and so you're going to make different decisions. You're not going to buy that advice. You're going to find out for yourself.
Yeah.
Good. Good deal. Cool. Yes.
I think so that millennials not buying houses is a little bit skewed because out of the 30 houses that I rehab, 5 of them have been sold to people under 25, and out of those 5, 4 of them have been male.
Okay.
Kind of interesting, and each time it happens, I'm like, what? So I think to the investor mindset on those individuals is huge. You know, and one of them's an electrician. He's never even hardly home.
Those were investor buyers you were selling to, not home buyers?
These are retail buyers.
Retail home buyers. Yeah, I think here's a question I would ask myself. If I have a belief about the housing market and it came from the media, it's probably wrong.
Right.
Okay, I hope we all can agree right now that no matter who you like, the media they've all chosen up sides now. And so it's really, really hard.
Real estate part out of that, just say if your beliefs come from the media,
It's probably a mistake to believe them in general, yeah. It kind of sucks, actually. It would be nice that you could actually see a story and believe it, but like I've gotten to a point now where I disbelieve it first. And that's why our whole thing is learn this for yourself. It isn't complicated. It's actually very common sense. If you've got the transparency on the data, it's very common sense, but believe what you see. You know, to the gentleman's question about the economy going into the tank in a couple of years, yeah, I know there's a lot of talk about that, except that I don't see evidence of it. And so I'm going to discount the talk and just focus on the evidence. Somebody over there had a question, though. Yes, sir.
I thought those trend lines in that data was very interesting, but the multiplier, the percentage on the bottom, that algorithm, is there a sweet spot? Like, is the higher the number, the better outcome, or is there a sweet spot you've seen in that?
That's a great question. Okay, so you're talking about the fact that nationally 3.4% was the national average, and we had a couple that were higher, a couple that were lower. Here's the interesting thing. I didn't touch on it, but I'm glad you asked. There are two components that make up ROI in real estate. There's the yield and there's the appreciation, right? Yield is how much profit you make on the rents, and appreciation is how much more valuable the place gets. I'm talking to the choir, I know, but I'm just defining it. When you add those two things up, it ends up being a 9%. Okay, now I'm not talking about buying it under market value. I mean, paying market value, renting it out at market rents. Housing in America is a 9, give or take, all right? So Charlotte is like a 6 and a 3. 6% yield, 3% price appreciation. Dallas is also a 6 and a 3. Funny how that works, because they're two southern cities that are big job meccas that are pulling population in from the cold climates. If you go to Ohio, you go to Cincinnati, 7 and 2. All right, so you lose on the appreciation, but you gain on the yield, and of course those things are connected. Because the prices haven't gone as high, you can buy the place a little cheaper because the chart is flatter. Detroit is like, so my point is sometimes you can find a 12 or an 11, right? So Detroit is actually like an 11 because it's like 11 or 12 minus a point, all right? So the question is the yield, if you get in now, the yield's gonna hold because you got your basis. Now if the appreciation catches up and you just get 2 or 3 points, now you're at a legit 14, 15, and you're doing it because you're taking a risk, but the question is, are the risk factors mitigated now, right? DC is like a 4% yield and a 5% appreciation. Same thing with Raleigh is kind of like that. Austin is kind of like that. I find it fascinating that Raleigh and Austin have very similar yield and appreciation profiles, and they're also blue cities that are state capitals in red states, right? They also have big university drivers for the jobs. These are hipster towns, they're cool towns. Like, there's a lot of qualitative similarities that translate to quantitative similarities. And so bottom line is, to answer your question, yeah, but there's a balance. And that comes back to this idea that no matter where you go around the country, they tend to balance out until you find those anomalies.
So are you more like, for example, like Detroit, where it was low and almost negative at one point, but the risk factor can grow it? Do you focus on more upside potential or more like, straight line?
I like finding the places that are popping. So to me, I don't go after distress. I go after distress that's in the rearview mirror. Like, I'm not looking to bet on something to change. I'm looking to bet on something that already changed but hasn't manifested yet. That's kind of the cool thing about real estate. It's this lumbering, slow-moving thing, right? So I think what needed to happen in Detroit has happened. As long as like what's happening there now is that the auto industry is coming back. But there was a headline a month and a half ago that GM was dropping some facilities and dumping a large number of jobs, 300 or 400 jobs. I said, okay, damn it, what just happened here? All right, so I went and read about it, and a month later, an announcement of many more jobs coming in for autonomous and electric automobiles. And so they're not just coming in and saying, President bribed us and muscled us, so we're gonna have to open a factory, right? They're saying, we wanna open this factory. I say that as, it's true, right? I'm neutral, don't have to care about the politics. Those companies got coerced into coming back and probably seduced with massive tax incentives. right? And so now here they come. They're coming back. And it's permanent. And when I saw them pulling back, I got nervous, but then I heard that it was because what they were closing was obsolete in their minds, and what they wanted to open up there was the future. Anything else? Last one? Okay. Thank you. Appreciate it.